Hi everyone, I'm Nikki Vachon. I'm a college access counselor at the Finance Authority, Maine. Thanks so much for joining us for today's Wednesday webinar, Managing Student Loans During and After COVID-19 Pandemic. We have fame, and many people on this webinar work with student loan borrowers, or maybe they even have student loans themselves. This pandemic has been such a stressful time for so many people. A lot has happened with student loan policy, and a lot's been happening to help ease some of that stress. So policy continues to change. And so I just wanted to make sure we got some information out to folks. I reached out to my go-to, Betsy Mayotte, to kind of see what's happened in response to the pandemic and what we should expect, what we might see in the future. So just to introduce Betsy, who I lean on frequently, she's an amazing resource. She's the president and founder of the Institute of Student Loan Advisors, TISLA. She's been working in the student loan industry doing compliance and advocacy work for over 20 years. She's helped thousands of borrowers with their student loans and this college access counselor when she has questions. Betsy has served as primary negotiator for several federal Title IV negotiated rulemaking sessions on topics such as the use of student loans at foreign schools, loan rehabilitation, and borrower defense. She also conducts regulatory trainings for the higher education financing industry, both in the US and as far away as the United Kingdom, Canada, Australia, and New Zealand. She's regularly quoted in the media on student loan issues and was a frequent contributor to US News and World Report's blog, The Student Loan Ranger. Betsy was born and raised in Lowell, Mass, and she currently lives in Plymouth. Thank you so much, Betsy, for joining us. I'm going to hand it over to you.
All right, sounds good. Thanks for having me. I love talking about this stuff. So the way we're going to roll today is I'm going to just sort of do an overview of the current waiver situation and who's eligible and so on. I'm going to talk about how to manage loans if you're working with a borrower who might not be eligible for the waivers, or even if they are. And then we're going to talk about counseling for when the waivers are over. And then we're going to talk some politics, everybody's favorite. So just, shameless plug to explain what TISLA is. I founded TISLA to sort of to counteract what I was seeing as a plague of these so-called debt relief companies that prey on vulnerable borrowers who are desperate for help with their student loans. So we're a nonprofit. We're Massachusetts based in that that's where I live, but we serve at the national level. And our core mission is to ensure that everyone has access to free, expert, and unbiased student loan advice and dispute resolution. So anyone can utilize our website. We don't require registration. We don't collect people's information. I'd like to think it's pretty thorough and in plain English. And if people need additional help, they can email us, and we answer most questions within a business day. And again, we will also help people with disputes. Just last year, we were able to assist over 4,000 individual borrowers one-on-one, and that doesn't include people that participated in a webinar or self-served on the website. So feel free to refer borrowers to our website and to our contact page if you run into someone that we might be able to help. So, and then the last piece of housekeeping is that my attorney makes me tell you that this presentation, that I'm not an attorney. This isn't legal advice, and this is for entertainment purposes only. So, it's a good thing that you're recording, Nikki, so people can binge watch it when they finish. When they finish Schitt's Creek, they can watch this. It might be a good sequel to Schitt's Creek. All right, so let's jump right into it. So I think, especially the people on this call, most of you are probably aware of this, but it never hurts to review it. So between the various executive orders beginning back on March 13th, and then the piece of legislation that Congress actually managed to pass, which is the CARES Act, and then we had other executive orders, student loan borrowers and schools for that matter have received, in all my years, what I would consider unprecedented relief during this particular crisis. I was doing this work during 9/11, during Hurricane Katrina, and what they're doing here really is unprecedented. Unfortunately, it doesn't cover all borrowers. It only covers about 80, depending on who you ask, between 80 and 85% of all federal student loan borrowers. So the loans that are eligible for these waivers are direct loans. And doesn't matter if it's a Stafford or a Plus or a Parent Plus or a Consolidation. And that includes direct loans that are defaulted loans. So the key is that the loan has to be a federally held federal loan. Now, the old FFEL loans, Federal Family Education Loan Program, and Perkins loans usually are not considered federally held. They're considered what we call commercially held. So even though it's a federal loan, it's held in the case of a Perkins by the school, or in the case of a FFEL loan by the lender, such as Sallie Mae or Chase Bank, or so on. To make things extra confusing, there is a small portion of both FFEL and Perkins loans that have been sold or subrogated to the Department of Education and therefore are considered federally held and therefore eligible for the waivers. So if you're working with someone that has a FFEL or a Perkins, today, in December of 2020, the easiest way to tell whether they're eligible for the waivers is log into their account and look at their interest rate. If the interest rate says 0, then they're one of the lucky small percentage that actually has a federally held FFEL or Perkins loan. If the interest rate says anything other than 0, then they're commercially held FFEL or Perkins. Back in the beginning, what we were telling people, and it stands true, it's just not necessarily the easiest way anymore now that the waivers have been implemented. But if you log into studentaid.gov, formerly NSLDS, at the FFEL and the Perkins, and you take a look at who the guarantor is, if the guarantor says Department of Education, then it's a federally held FFEL or Perkins. If it says anything else, then it's still a commercially held FFEL or Perkins. State loans can never be eligible for these waivers, nor institutional loans, nor, of course, private loans. Now, even though this was done in various ways, they thankfully did a pretty clean extension anytime they changed anything. So without getting into all the different chapters of this epic tale that is the COVID waivers, effective March 13th, there is a 0% interest rate on loans that are eligible for these waivers, which is what we just went over. And as of last Friday night at 5:30, just as I was about to have my Friday night cocktail, which I immediately had to put aside, they extended it to January 31st, including defaulted loans. For that same period of time, no payments are due. And what's even better is that the loans are being, with the exception of the defaulted loans, which of course are still being reported as in default, this period is being reported to credit bureaus, not that the borrower is in forbearance or deferment, but that the borrower is actually making payments. So there's absolutely zero negative consequence to this particular status. The other really nice thing about this period is that this period does count for PSLF and income-driven plan forgiveness purposes, as well as rehab. I'm going to talk more about rehab in a little bit, but I can't be clear enough on this because there's, according to the Department of Ed's data, there's still approximately 300,000 borrowers that are actively pursuing PSLF who have actually been making payments during this period. Making payment, if you're pursuing PSLF and you have a fairly high confidence level that you're going to be staying in public service and not pay the loans off beforehand, and therefore will receive forgiveness under either PSLF or the income-driven plan forgiveness, paying during this period is the equivalent of throwing that cash at a wood chipper. It's not going to get you forgiveness any earlier. It's not going to save you any money. You're stealing from yourself. So if you are someone that, what I'm seeing from borrowers that have been paying during this period when they don't need to and they're pursuing PSLF, the reason they're doing it is because they don't trust PSLF. And it sounds too good to be true. And they want to make extra sure they don't screw anything up and they actually get forgiveness under PSLF. I get it. The program's been fraught with peril. It can be a little nerve-wracking if it can make a big difference in your financial future, which it will for a lot of PSLF borrowers. So I get why people want to wear a life jacket during this period, but I'm here to tell you it's in writing on the Department of Education's website. I have it in writing from their policy people. It's written into the CARES Act itself, which is statute. So I can tell you 1,000%, as long as all your other eligibility remains, such as you still do need to be working for a PSLF eligible employer during this period, and it has to be direct loans. This period does count for PSLF. So if you're someone that's been making those payments, you should call or email and request a refund, and they will give it to you. And it's actually fairly quick. I've seen most people get their refund, some of them less than a month, but usually around 45 days. So any payment you made after March 13th, they will absolutely send back to you. So, again, I said in the beginning, I can't emphasize this enough, but if you're pursuing PSLF and you've been making payments, stop it. Moving on. So while there is no interest that's accruing during this period, most people are going to have at least a little bit of interest that will have accrued between their last payment and March 13th when the interest stopped. Now, and normally, with no exception that I can think of, anytime that you go from a non-repayment status to repayment status, any outstanding interest capitalizes, whether it was interest that accrued during the period you weren't making payments or whether it was interest accrued before that. So this is a huge exception in that the CARES Act waiver is not going to result in capitalized interest unless something else happens that normally would be an interest capitalization event. So for example, when you come out of your grace period, any outstanding interest that you might have on, say, an unsubsidized loan is going to capitalize. If you come out of your grace period during the COVID waiver, you can still expect interest capitalization for that reason. If, another thing that would have caused a lot of people's interest to cap is if you fail to recertify your income-driven plan on time, your interest will capitalize. Thankfully, they've extended the recertification period for the IDRs. So if you were due for IDR recertification during the waiver period, so as of the 2nd, between March 13th and January 31st, your anniversary date's been pushed out by a year. So if you were due June 21st of 2020, your new IDR recertification as of right now is June 21st of 2021. So we don't have to worry about interest capitalizing because people didn't recertify their IDR. If you were in a deferment or forbearance as of March 12th, you can expect the interest to capitalize as a result of those things ending, but again, not as a result of the CARES Act waiver itself. And we did already talk about credit bureau reporting, and I am going to cover rehab more as I promised in a few minutes. But before I move on, how are we doing with questions, Nikki?
So I have a question about if you can get a summary of examples of PSLF protection in the CARES Act statutes, but I feel like that might be something we might want to do in a follow-up email.
I can give some examples now. So let's say as of March 13th, you had 100 eligible PSLF payments already under your belt, and your job wasn't affected by COVID, so you've continued to work full-time for an eligible employer in April, May, June, July, August. As of August, you would have, and you made 0 payments from March 13th to August. So remember, in my example, in March, you had 100 payments under your belt. In August of 2020, you'd have 105. Now, where it could get confusing is that Fed Loan Servicing, which is the PSLF servicer, they haven't, they have a new tool on their website that shows the number of eligible payments you have under your belt. That tool is, I don't want to say it's for entertainment purposes only, but it sort of is. You can't really count on that. But when it comes to this PSLF CARES Act stuff, they have not updated all of the borrowers for this eligible period during the CARES Act. Doesn't mean you're not going to get credit for it. You will get credit for it. But keep in mind, they're also not going to give you credit for it until you submit your employment certification for this CARES Act period. So if you haven't done that yet, you haven't gotten credit for those payments yet. But once you do, they will give you credit for those months, just like you made a payment.
Awesome. I just had one more statement from the chat. We had someone who did make a payment, and in March, they requested to get that payment back, and it only took 2 weeks. So pretty quick turnaround.
Yeah, it's been super fast. I've been really impressed because, remember too, in addition to all the added volume that the services in the Department of Ed has had, especially in the beginning when there was a lot of confusion around the waivers, they've had their own COVID issues to deal with. And it's not as easy to send, the guy that processes the IDR paperwork to work from home because of all the information security requirements that are around touching Department of Education student loan borrower data. So I've been pretty impressed with that refund time frame myself.
Great.
Anything else so far?
No, I think that is it.
Okay, so moving on. All right, so as promised, let's talk about defaulted loans. So again, this is for defaulted loans that are federally held defaulted loans. So they stopped involuntary payments. So that means administrative wage garnishment and tax refund offset. As of right now, that's on hold through January 31st of 2020. And any Social Security or AWG or tax offset or other involuntary payments that were taken after March 13th, they were refunded, and they were refunded automatically. You didn't have to ask for the refund for that. Now, you probably saw some news stories that there was still, I want to say it was like 85,000 accounts that were still having AWG taken. Last I heard, part of that was because the employer wasn't around to shut it off because they had shut down due to COVID. So they have since been able to shut almost all of them down. I think there's only a handful left that are still getting garnishments through AWG, but those again are being refunded. They also stopped all other collection activity, and that again is likely through January 31st of 2021. Now, when it comes to rehab, if it's a loan that's eligible for the CARES Act waiver, now this is really, I think, extremely generous. So normally under loan rehabilitation, you have to make 9 consecutive on-time payments in an amount that is agreed upon between whoever the loan holder is, in this case, the Department of Education, and the borrower. Under the CARES Act, these months count towards the 9 months of loan rehab without the borrower having to make a payment. So pretty much the same as PSLF. So unfortunately, I haven't seen a ton of outreach about this or a ton of press, which is unfortunate because this is a real opportunity for borrowers that have been struggling to get out of default. The only way you can take it, they only count months after you sign the rehab agreement though. So even though we're in December, and as of right the second, the waivers are supposed to end January 31st, as you'll see later on in my presentation, I think there's a very good chance they're going to extend the waivers further. And I would expect, although it's not guaranteed, I would expect another blanket extension. With that in mind, even though we're already in December for this waiver period, if you're working with borrowers that are in default, I would strongly encourage them to sign the rehab agreement as soon as possible so they get credit for those months after the fact. Now, one thing of caution, the loan rehabilitation is a great opportunity for a defaulted borrower to get a second chance. It dramatically lowers the collection costs, in some cases down to zero. And it removes the default line from the borrower's credit report like it was never there, which can be a huge positive impact on someone's credit score. With that in mind, you can only rehab once. So I have worked with borrowers in the past that when you look at what their payments are going to be, even with a lower payment option, once they get out of default, they'd end up defaulting again. So if you are working with someone and they're in default and you want to encourage them to take advantage of this rehab provision, I would just make sure that you set them up for success in the long term before you go ahead and encourage them to do that. If there's no way they can afford any of the lower payment options once they get out of default, they might be better off actually staying in default, at least for a little while. It can be a tricky scenario, but I wanted to point that out. Now, despite the fact that there was no collections being done, borrowers, of course, are allowed and encouraged to make payments during this period. They remember they're also getting a 0% interest rate. So it's a good opportunity for someone, if rehab or consolidation is either they're not eligible for it, it's not a good choice for them. It's a good opportunity for them to lower their balance with this 0% interest rate. Now, the borrower communication, the CARES Act required the Department of Ed to work with the servicers and send out no less. Now, remember, originally the waivers were supposed to end at the end of September. And the Department of Education was required to send out a minimum of 6 communications. Well, then the waivers got extended to December. So they'd already sent 5 of the 6 communications out. And then, of course, they stopped. I would expect that they would be required to send out a minimum of 6 communications once we get closer to whenever the waivers are going to actually end. But for the sake of borrowers that might be getting confused, I hope if they do extend it, which again, I think they will, I hope they do it sooner rather than later. So the borrowers aren't again getting a whole bunch of communications saying payment's going to start. Oh, never mind. I mean, the more we do this, it's going to be even harder to get borrowers back on track once the waivers are lifted, whenever that may be. But I've seen some of these notifications. All but one was email. And it's a lot of really good information about what your options are if you can't afford your payments, when the next payment's going to be due, information about income-driven plans, etc. All right, so are there any other questions about CARES Act eligible loans before I move into the non-CARES Act eligible loans?
Yeah, so I just wanted to reiterate with the acronyms TOP and AWG. What does that stand for?
TOP is tax offset. I forget what the P stands for, but that's what it is. And AWG is administrative wage garnishment. So they're taking money directly from people's paychecks.
Perfect. Okay, and just to reiterate, if someone is working towards PSLF and they're pretty sure they're going to qualify for it, you're recommending ceasing payments right now.
I'm not only recommending ceasing payments right now, I'm strongly recommending that they get a refund for the payments they've already made since March 13th.
Because they're going to count anyway.
Mm-hmm.
Okay, that's it. Thanks.
All right, so let's talk about what's been going on for the loans that aren't eligible for the CARES Act waivers. So non-federally held federal student loans, they could have been put into what's called a disaster forbearance. Now that's our old school go-to, what to do if something terrible happens to a whole bunch of people in the same place. Now, what I saw in the industry is that it was sort of all over the place. There were some loan holders that just put everybody in the 90-day disaster forbearance. There were some loan holders that waited to be asked. So I think you'll see different things from different people. The problem is the ones that got put in. Oh, and there were some that waited till the borrower was 30 days past due. And then if they didn't hear from the borrower, couldn't get in touch with them, they would put them in this disaster forbearance. The problem with that is that, all the press kept talking about this student loan payment waiver. And then so people have, well, I have a federal student loan, so I guess that means me. They don't pay. They aren't getting any delinquency notices because they've been put in this disaster forbearance. And then all of a sudden started in June, they get a notice that they're due for payment. And now they're super confused because they thought they'd been eligible for the waiver. So we saw a lot of that. I'm still seeing that. And now some of these borrowers are getting into the danger zone where they're starting to approach default. And there's no moratorium on default for these non-federally held federal student loans. So, if you're working with someone with these type of loans, those are the sort of things that you need to be watching out for. Now, if after the 90-day disaster forbearance was over, the borrower was still struggling, it was possible for it to be extended, but there was also potential eligibility for other options that I'm going to talk about in a second. During the disaster forbearance, interest does still accrue. These loans are not at 0% interest. And there's been a strong request from Congress to apply these waivers to all of these loans, but as of right now, they haven't done it. And I don't see them doing it if they happen to pass a stimulus bill between now and December 18th either. The Department of Education's response was a little catty. They sent out a notice, I think it was April 3rd, was this guidance, and said, hey, the lenders are perfectly within their right to offer 0% interest if that's what they choose to do, but we're not going to reimburse them for it. And as far as I know, none of the lenders did end up offering 0% interest. If a borrower was put in this disaster forbearance and they don't need it and they don't want it, they can ask for it to be removed. They also can continue to make payments. FEL loans, if you remember, are eligible for what I call old school IBR, which does have a forgiveness component. If you were put in the disaster forbearance, whether you kept making payments or not, if you don't have that removed, that period is not going to count towards IBR for these non-federally held or commercially held FEL loans. Now, if a borrower is unable to pay and they have a commercially held FEL or Perkins, there's several options that are available to them. One, they could consolidate into the direct loan program, and then they're eligible for the waivers. There's pros and cons to that. If the borrower is pretty far along in their repayment term, consolidating just is going to extend the term all over again. And for however many months they get the 0% interest rate, if they don't have the financial personality that would have them continue to pay what they were paying in the first place instead of the lower payment, it could end up costing them money in the long run. Income-based repayment, like I said, old school IBR is available to FEL borrowers. Then there's the unemployment deferment and the economic hardship deferment. Unemployment deferment is allowable on both the FEL and the direct loan side. And it's if you're working less than 30 hours a week. A lot of people think you have to be completely unemployed and working zero, and that's not the case. You're working less than 30 hours a week, and you have to actively be seeking full-time work to be eligible for that deferment. To obtain it, there's a form you have to fill out, which you can get off of the servicer website, the Department of Ed's website, my website. They're all over the place. The other option for those borrowers is the economic hardship deferment. Now, there's about a half a dozen different ways to qualify for it. Back in 1993, there were, I think, 24 different deferments available to borrowers. Everything from working mother to if you adopted a child, temporary disability deferment. There was all kinds. What they did in 1993 is they swept most of those up together, got rid of them for loans made after 1993, and then created this economic hardship deferment that was intended to sort of cover all of that. It really doesn't. But here we are. So the economic hardship deferment, if the borrower is receiving some sort of benefits, such as food stamps, etc., that would qualify them for this. If their income is below 150% of the poverty level, that would qualify for their family size, that would qualify them for it. Also, if they're in the Peace Corps, that would qualify them for this economic hardship deferment. Now, under a deferment, of course, interest doesn't accrue on most subsidized Stafford loans, so that's a benefit, but it does still accrue on the unsubsidized loans. So if a borrower is going to take this action, if they can afford to, you should encourage them to at least pay the interest while they're in this deferment, because unlike the CARES Act waiver, once they come out of this deferment, any accrued interest that's not paid is going to be added onto their principal in the form of capitalization. As of March 25th and April 3rd, depending on the guidance, most of this was in the April 3rd guidance. The Department of Education also advised student FEL guarantee agencies to cease involuntary collections on those loans as well. So there was no Social Security garnishment. They also wanted to remember, people got stimulus checks around that time. They wanted to make sure that stimulus checks weren't being garnished. So they also advised in that April 3rd letter that guarantee agencies should stop doing involuntary payments on the defaulted loan. So they all did. Now, they were borrowers, if a tax refund or any other type of involuntary payment was taken after March 13th, the borrowers could request it back. Unlike the direct loans, it didn't happen automatically. The borrowers did have to request it. Now, I do know there were a couple of guarantors that actually sent it back automatically anyway, but most of them did not. They waited to be asked from the borrowers. Now, we're past September 30th now, which is that April 3rd guidance did instruct the commercially held felon Perkins to cease collections until September 30th. But then a funny thing happened around September. So the extension happened with executive order for the federally held federal student loans. And the FEL community went, okay, so do you still want us to stop ceasing collections? And the Department of Ed came back and said, we didn't mean what we wrote on April 3rd. In April 3rd, even though the letter says we're telling you to stop collections, we were giving you that option instead. So therefore, we're not going to tell you to cease collections moving forward. It's up to you. So where we stand now is sort of all over the place. I know that there are some guarantee agencies that flipped all the switches on. They're starting involuntary collections, so AWG, tax offset, Social Security offset, all of that. Some are not starting involuntary collections, but they are starting regular collections. So they're starting to reach out to the borrowers again via phone and mail. And then there are some that are doing nothing. And then there are some that are sort of in between. Instead of doing collections, they're doing what they are calling goodwill calls, where they're not sort of aggressively collecting on these defaulted loans, but just saying, hey, we're still here. You still owe some money. Can we help you in any way? So we're seeing sort of all flavors in that regard. And I think for those that chose not to initiate collection activities yet, I have a feeling that they're going to wait and see what happens after the inauguration. But that's just a gut. I have not talked to all remaining 26 or 28 guarantee agencies. This period of non-collection does not negatively impact loan rehabilitation, and I'll explain what I mean by that in a second, but it's not as cool as the CARES Act provision. So, let's say in March, a borrower was 3 months into their 9-month required loan rehabilitation payments. If they stopped making payments after March, come September, they could pick back up again at payment 3, but they wouldn't get credit for the 6 months that they didn't make payments. Or the borrower could choose to keep making payments and sort of stay on track, and they'd be ready to rehab once they made their 9th payment in September. So again, rehab, there's not a negative impact by not paying during the COVID period, but you also don't get credit like you did make a payment. And with that said, I'm going to take a breath and see how we're doing for questions.
We are all set on questions, so you're doing an amazing job.
Okay, or they fell asleep or
Absolutely not.
or watching TikTok.
Good stuff.
All right. So that covers what's been going on with the federal loans, whether they be commercially held or federally held. Let's talk about private loans and other non-federal loans. So I think we all know that private loan programs vary, sometimes even within a single lender. A single lender can have multiple private student loan programs that have different terms and conditions. Now, what I saw in the beginning, so in March, when everybody was like, all right, all hands on deck, what can we do? I saw some lenders that quietly lowered people's interest rates and put their payments on hold. I saw the other end of the spectrum where some lenders didn't offer any type of relief except the normal forbearance that they offer and for a fee. I had a borrower reach out to me that had they and their spouse had lost their jobs due to COVID, and they reached out to their private lender and they were only offered a forbearance for 3 months, and they had to pay $50 per loan to get that forbearance. So, and then I saw everything in between. Most lenders, most private loan lenders, once the loan becomes delinquent, they actually have a little more freedom under their regulators to offer options for relief. So they can, sometimes it looks like lowered interest rates, sometimes it looks like interest only payments. And so at the very least, even if the lender wasn't offering any type of COVID special relief, most borrowers were able to get at least something once they became delinquent. It's a lot like how the mortgage relief programs worked back in 2008. Um, the best advice we were giving people is just, if you're experiencing hardship, call them, because there were so many different things going on within the private loan arena that there was no way to sort of aggregate them. And so the best thing to, and a lot of lenders weren't advertising things either. So you really just sort of have to call if you're struggling with a private loan. There were some states that were considering laws requiring lenders to postpone payments during this period. And there was a law passed that in 12 states that made it appear that they put the loans on hold, but what they actually did is required that 90-day disaster forbearance for the commercially held FEL. There was nothing that required the stop of payment on private student loans. That what that law also did, unfortunately, was cause some confusion, because the law did require the lenders to stop collection activities for those 3 months. So again, we had borrowers that assumed because they didn't get a delinquency notice or a delinquency phone call that their loans were eligible for the CARES Act or some other type of relief, when in fact they were not. So they were in for sort of a nasty surprise once that 3-month period was over. Oh, we already talked about that. Okay. The advice that we were giving to borrowers with loans that were eligible for the CARES Act is, first of all, and we were saying this back in March and April even, but I continue to say it. We don't know what the full economic impact of COVID is going to be. So even if your income has not been affected, and hopefully it won't be, you should plan for the worst and hope for the best. So I've been encouraging people to bulk up their existing emergency fund. If you normally have 6 months of expenses, try to save a year's worth of expenses. If you normally have 3 months, try to at least have 6 months, just to be on the safe side. Then take a look at other sort of high interest debt you might have, credit cards or something else. And once all those ducks are in a row, if you can afford to pay, you should absolutely pay. And you should pay as much as you can to take advantage of this 0% interest rate period. Again, with the exception of those pursuing forgiveness under PSLF or the income-driven plans. You should absolutely be making payments. If you did have interest that accrued prior to March 13th that's sitting out there, when you first start sending payments, they have to apply that money to that accrued interest. But that's good, because you don't, you want to get that out of the way. I saw the little thing flashing. Were there any questions before I started getting into post-pandemic?
Just one question, could it be considered a gamble to do this with more talk of loan forgiveness looming, or is that still considered too much of a long shot?
I am going to cover that.
Thanks.
So stand by. All right, so I chose this picture for the background because it's something I haven't seen in a really long time, which is a crowd of people with no masks on. And without protest signs, I should say. And I cannot wait to be part of such a crowd at some point, and I'm sure the rest of you feel the same way. The bottom line advice for managing loans post-pandemic is what I said a few minutes ago, which is prepare for the worst and hope for the best. Whenever the waivers are lifted, and I'm going to prognosticate on when that's going to be in a few minutes, this is what we're facing. Now, the Department of Education and the servicers are actively trying to prepare for this, but you cannot prepare for 40 million student loan borrowers entering repayment at the exact same time and during an economic crisis. So again, whether that happens at the end of January, at the end of June, at the end of September, this is what it's going to look like. And people need to prepare for that, and prepare to have patience. So the number one messaging that I've used with borrowers when they talk about the waivers, when they talk about what's going to happen when the waivers are lifted, is patience. So, I expect there's going to be longer call wait times. I expect there's going to be, it's going to take longer for paperwork to get processed. All of those things. Now, hopefully, Congress or the Department of Ed will take some other actions to make sure borrowers aren't unfairly dinged in that scenario. But again, we have to prepare for the worst and hope for the best. So if you're working with a borrower, now's the time to sort of evaluate where they're going to stand when the waivers are lifted. So right now we're assuming January 31st. So these are the types of, the first thing you need to do is to understand what the landscape is. So you want to make sure they know what kind of loans they have, because just because they haven't been getting a bill doesn't necessarily, you can't 100% assume that means that they were eligible for the waivers. The best way to check is see if they have a 0% interest rate. So what kind of loans do they have? Does their loan servicer have their current contact info? If you're not paying loans for 9 months or more, you might forget to send that "I've moved" postcard to your loan servicer. So you don't want to all of a sudden end up delinquent and miss the fact that loans went into repayment again because they don't have your correct contact information. So you want to make sure that's that's accurate. Did you have accrued interest on March 12th? And the way to see that is to log into your account and take a look. Is there interest sitting in the accrued interest field? If you did have interest accrued as of March 12th, what status were you in? If you were in a repayment status, don't worry about it. That interest isn't going to capitalize. You should still try to pay it, but it's not going to capitalize. But if you were in your grace period, forbearance, or deferment, you want to try really hard to pay that interest off. Otherwise, it will capitalize. What's your payment going to be once the waivers are lifted? You were on an income-driven plan as of March 12th, and you haven't sent in new recertification information. Your payment's going to be the same in February as it was on March 12th. If you weren't on an income-driven plan, but you were on a different type of plan, chances are the payment, again, is going to be the same as it was in March 12th in February. Are the loans in default? If they are in default, is loan rehabilitation a good option for you that you should start pursuing now? Will I be able to afford my payments as of January? And if the answer is no, can I afford a lower payment, or can I afford nothing at all? How much can I reasonably afford? And I know I've said this a dozen times, I'm going to say it another dozen more. Am I actively pursuing a forgiveness program such as PSLF? And am I reasonably sure that I'm going to obtain forgiveness in the end? The name of the game here is, like it is always, is paying the least amount over time. So if you're working with someone, they might automatically gravitate to the cheapest monthly option, but if they can afford to pay more and aren't pursuing a forgiveness program, even post waiver, the best way to save money on interest is to pay the loan off as soon as you can. I just want to go over again whose interest is going to capitalize and whose isn't. So in this example, we have Hansel and Gretel. On March 12th, Hansel was in a discretionary forbearance or voluntary forbearance that was due to end on June 7th. As of March 12th, Hansel had $1,000 in interest that had accrued. In that scenario, Hansel's interest will capitalize, and it'll capitalize on January 31st when the waivers are over. On March 12th, we also have Gretel. Now, on March 12th, Gretel was on an income-driven repayment plan, but her payment amount was not enough to cover the monthly interest. So she's been slowly accruing interest as she's been under this income-driven plan. And she also, on March 12th, had $1,000 in outstanding interest. But because she was in repayment and there's no interest capitalization event that's going to occur, her interest will not capitalize at the end of January. So I hope that helps explain that scenario. just like what we talked about with the commercially held Fell and Perkins loans, once the waivers are over, borrowers have the option of loan deferment. For most of them, it's either going to be an unemployment deferment or economic hardship that they would request directly from their loan holder. They also have the option of forbearance. We generally advise this as a last resort, not only because interest accrues on both subsidized and unsubsidized loans while the borrower is in forbearance, but frankly, it's good to keep as a last resort in case you're not eligible for other options. Forbearance can sort of be that lifesaver. You're only allowed a limited amount. For some loan holders, it's 24 months. For some, it's 36 over the life of the loan. So you really want to save forbearance until you're in case you are ever in a situation where you're not eligible for anything else. The problem is forbearance is like the easiest thing to get. You just have to call and say, I lost my left sock. I'm distraught. I need a forbearance. They'll give you a forbearance right over the phone. So people tend to sort of do that because it's the quickest thing to take care of it. But again, I strongly encourage people to hang on to their forbearance time and use it as a last resort. But with that said, it can be a good option for, say, the borrower themselves, their income hasn't changed, but the other income contributor of their household, their spouse or their significant other, they lost their job. So there isn't going to be any lower payment option that might be helpful to you. It's not going to, on your paper, it's not going to look like you qualify for any of them. That's the time to use a forbearance. And of course, there's all the lower payment options. Some of them, both the FEL and the direct loans are eligible for. Some of them are for direct loans only, specifically pay as you earn, revised pay as you earn, income contingent. Now, income contingent repayment is the only income-based repayment plan that Parent Plus loans are eligible for. And the Parent Plus loans have to sort of jump through a little hoop to get access to it. Parent Plus loans as they stand are actually not eligible for any of the income-driven plans. But if you consolidate a Parent Plus loan, it then becomes eligible for income contingent repayment. Before you have a borrower go ahead and do that, because consolidation has its own potential implications, you'll want to run their numbers through either the Department of Education's loan simulator, or we also have a repayment calculator on our website, just to make sure that the income contingent repayment plan will be a payment that the borrower can afford, rather than have them consolidate only to find out ICR might not be the best option for them anyway. How are we doing with questions?
Just one, assuming nothing changes and borrowers go into repayment in February, will everyone have the same repayment date that they had before, or will it be like all going to be due on one day? I can't imagine. It must be their same day, would you say?
I can't imagine them. I see no reason for them to change the monthly due date.
Right. And will they have to immediately recertify their income if they're an income-driven repayment plan?
Nope. I mentioned earlier, so what they've done is they've extended the recert anniversary dates out by a year for people that came due during the waivers. So if you were due in July of 2020, now you're due July of 2021.
But
The other thing they've done is, let's say you weren't due inside the waiver period. Let's say your anniversary date is January or February of 2021. They've pushed those out a little bit to the end of March. Now that was based on a waiver end date of December. I haven't heard that they've changed that portion. I don't expect they will again. I think they're waiting to see what's going to happen with the Biden administration. But again, I'm going to cover that shortly. And I've got to kick up. Time flies when you're having fun. We're at 10 of already.
it does. That's it for questions.
Okay. I'm willing to hang out for a little bit after too, if people have other questions. So I'll just skim over this. If you need more information about loan rehabilitation versus consolidation, we have it in really good detail in plain English on our website under the default page. But if you're counseling someone that's in default, again, they should take advantage of the waiver period and sign a loan rehabilitation agreement so they get credit for those months if their loans are eligible. For borrowers that have already used their opportunity for loan rehab, consolidation is another way to get out of default. It's actually a little quicker. All right, so what I think a lot of people have been waiting for. Let's talk about pending legislation and whether the waivers are going to be extended. So this is what most people in Congress called Hell Week. We're looking at a potential government shutdown but it looks like that they're signing a 1-week extension to bring them to December 18th. December 18th is when it's supposed to be the last day that Congress is in session. Meanwhile, they're working really hard to try to pass at least a small stimulus bill. Now, nobody has seen the actual language of the stimulus bill, but we have been told that student loans are in there. So if Congress does manage to pass a stimulus bill, then we can expect the waivers to be extended. We don't know how long. Now, back in July, the Democrats passed the HEROES Act, which was intended to be another big stimulus bill. And they extended, in the HEROES Act, they extended the waivers to September. The Senate offered up their own bill, and that had a 0 extension of the waivers. So we all expected they were going to meet somewhere in the middle. That's my gut feeling too. If this small stimulus package passes, the student loan provisions, I'm putting my money on June for an extension, March or June, but I'm leaning more towards June for an extension. Now, if Congress doesn't manage to come to agreement and pass this small stimulus package, what we expect will happen is that Biden will get inaugurated, walk off the podium, grab a glass of champagne, and go start signing executive orders. And one of those orders we fully expect is to be an extension of the waivers. Now, how long will he extend it for? I'm still saying June. A lot of other people are saying September. I'm saying June. The reason for that is that there's actually pros and cons for doing a blanket extension. Should we be offering 0% interest and payment waivers to people who haven't been economically impacted is sort of the biggest and loudest argument. So that's why I'm saying June. I do think that whatever waiver happens, whether it be via Congress or whether it be via executive order, will be a clean extension, meaning all the things that are in place now, I think will be in place to whatever the new date is. Now, let's talk about the elephant in the room, which is student loan forgiveness. Now, just to be super, super clear, this is my opinion. It's my opinion only. Nobody should be making life decisions based on what I'm about to say. With that said, I don't think we're getting loan forgiveness. I think the chances are really awfully slim. Now, first of all, there's the argument of whether Biden has power under executive order to forgive student loans. So I am not an attorney. I'm not a constitutional scholar, but I do understand how executive orders work. And based on my research, he does not have that authority. There are a lot of people that are much smarter than me that also agree that he does not have the power under executive order for loan forgiveness. I mean, he could certainly write one, but it would almost certainly be challenged in court, and I think he would lose. Executive orders can't go beyond the statute. And as far as I can see, there is no authority in the statute for the Department of Education or the administration to write off a debt that's owed to the U.S. taxpayer. This money is owed to you and I. So I think even if he did write that executive order, I think he would get challenged in court and I think he would lose. And no one wants that situation to happen. The other reason I don't think he'll do it, I think he knows he doesn't have executive order privilege for this, because just last week he was making comments encouraging broad student loan forgiveness, and then said that Congress needed to get started on it. So someone who thinks they have executive order power to do something isn't going to call on Congress to sort of take that action for him. Now, there is a provision in that HEROES Act that I mentioned that the Democrats passed in July for broad student loan forgiveness, but I think that was a negotiating point. The Republicans are certainly not going to agree to broad student loan forgiveness. And then, there's been a lot of chatter, even from some of the stauncher, student loan forgiveness advocates, that student loan forgiveness now is going to actually benefit those with the highest incomes way more than it'll benefit those with the lower incomes. And it's questionable about whether it would stimulate the economy. So I can talk about this more if people are interested, but even if the Democrats were to win those 2 Georgia seats, which based on the $43 million in advertisements that the Republicans are pumping into Georgia, I'm not sure how likely that is to happen. But even if they were to win those 2 Georgia seats, we've still got a super, super skinny majority that's going to be hard to overcome for something like student loan forgiveness. The last reason that I don't think it will happen anytime soon is we just have too many competing economic priorities because of the pandemic. And even though 40 million people is a lot of people, not every one of those 40 million people needs help with their student loans. And there are a lot more people that need help with things like unemployment, small business, healthcare, and so on. So I just see Congress, I see it's more likely for Congress to agree to spend that money in those places than on broad student loan forgiveness. Now, with that said, who knows where we're going to be in 2 years? After the midterm elections, if the Democrats have a much stronger majority, conversation will be back on the table. But I just don't see even the Democrats making the decision of broad student loan forgiveness without addressing what the real problem is. And the real problem is not student loan debt. The real problem is the cost of higher ed. Even Biden's election policy proposals and talking points didn't just focus on student loan forgiveness. It was the whole package of fixing the cost of higher education. So the families that are affected by student loan debt the most, the low income and the middle class, can potentially attend college debt-free. And I just don't see Congress taking up forgiveness unless and until they're also taking up this cost of education issue as well. The first 100 days are super important to every president, pretty much since Teddy Roosevelt. So you're going to see a very busy administration during that period. My prediction is they'll pick the low-hanging fruit for student loans, which will be a potential extension of waiver, and rolling back some of the executive orders that took away a lot of the consumer protections associated with student loans under DeVos. I'm thinking gainful employment. I'm thinking bar defense to repayment, that kind of stuff. All those things are pretty easy to get wins on within that first 100 days. Legislation is going to be tougher. One of the benchmarks of presidential approval in those first 100 days is how much legislation can they get passed. And the Congress we have now, I don't know, one might say they're not super in a cooperative mood. I don't know if that will change post-inauguration or not. But just to sort of set the bar, Teddy Roosevelt managed to sign 77 pieces of legislation in his first 100 days. And then the lowest one was Bush the first, I believe, only signed 7. So for those of you keeping score, that's what we're sort of looking at. Did I cover everything I said I was going to cover?
I believe you did.
All right. So just as we're hitting the hour mark, here's some resources for you. We partnered with another awesome nonprofit called Mapping Your Future and created this website called studentaidpandemic.org. The intended audience for this is students that are in school, students that are making the college choice right now, and student loan borrowers. And it sort of puts together all the options for relief that are available to those particular constituencies. And we make a point of keeping it updated really quickly. So there's a ton of interactive training modules, there's a bunch of FAQs, and we generally update that within 24 hours of a major policy change. So use it, share it, it's free. Of course, there's our website. We also keep COVID information on our website, the Department of Ed's website, and the Department of Ed's coronavirus site, which can be confusing. They haven't completely updated. They've updated some, but not everything from this past Friday night. So it's a little contradictory in places. So proceed with caution right now on that one. And that's it. It's 2:00. So feel free to run away, or
Okay.
I'm happy to hang out and answer some more questions and try to tell the future.
I have no open questions. I do want to mention that the website that you put together with freestudentadvice.org is amazing. Student Aid Pandemic, I'm just wondering if you have any social medias that people should follow or anything, something so they get alerts, or just check it out from time to time.
Yeah, the Student Aid Pandemic, it was not intended to be a whole new organization. It was just a place for mapping your future in TSLA to, try to make sure there was a resource for students and borrowers. So once the pandemic's over, we're going to retire the site, and that'll be the end of it.
Hopefully we'll never have to have it again.
But if you want to follow TSLA on social media, on Twitter, we're TSLA_SL. If you want to follow me, so the TSLA one, our audience there is mostly borrowers. So the messaging is mostly borrowers. If you want to nerd out with me more often, you can follow me on Twitter. I'm Betsy514. I'm on the student loan subs on Reddit all the time. Hashtag, sometimes they think I'm Betsy DeVos, so hashtag not that Betsy. And then TSLA also has a Facebook page.
I will geek out with you anytime. I think you're amazing. I don't see any open questions, and I just want to say thank you so much for all the times that you've helped me with really complicated questions, and I would really reach out. Betsy's an amazing resource for us. So
very nice.
Thank you very much, everyone, for joining us.
Thank you. Happy holidays, everybody.
Thank you. Have a great day, everyone.